It's your boy, Mr. Investor, coming here right now. Super excited and honored to share with you guys my brand new trading course here, 2020, Chapter 1, Introduction to the Stock Market. This is the video that we're going to get into. And guys, I hope you guys are ready. I hope you guys are staying laser focused to take in and soak in as much knowledge and information as possible, because I want you to succeed with me in the stock market. So I really am feeling, man, what's the word, man? I feel so grateful. I feel so appreciated. I feel so honored, really, to have you here and that you took the time and trust to take this course. So thank you again. Let's get started. Let's take a look at the course content here. Chapter 1, Basic Market Knowledge. This is just really the basic stuff, kind of boring, but you know, something that you still need to know. So I hope you guys still stay laser focused and get the knowledge that you need to get started. Okay, and after that, we're gonna get up to chapter 10, and that is gonna be closing off our beginner course. All right, so other than that, before we get started, I want to make sure everybody reads this disclaimer right here. Users of the service acknowledge the informed data is yada yada yada. All right, I want to make sure everybody reads, understands, and acknowledges this disclaimer. Other than that, if ever, I'm assuming everybody's read it and understood. Let's go ahead and get started. So what is the stock market? This is a very basic question that someone asks you, you're going to answer like what? The stock market refers to the collection of markets and exchanges where regular activities of buying, selling, and issuance of shares of publicly held companies take place. So such financial activities are conducted through institutionalized formal exchanges, or OTC, as known as over-the-counter marketplaces, which operate under a defined set of regulations. And now there can be multiple stock trading venues in a country or a region, which allow transactions in stocks and other forms of securities. Okay, so moving on here, we got the slide saying, so what are all these graphs, charts, tools, lines, and so on? Everybody comes in the stock market, everybody's all laser focused, eyes are around, thinking, man, I want to make a lot of money in the stock market because I follow this one guy, make a lot of money, and boy, oh boy, if I follow this guy, I'm gonna make a lot of money, but I am overwhelmed, right? What is all this charts? What is all this math that I kind of see? It's not math at all. I used to be so bad at math. I'm going to tell you that straight up. My honest answer, I used to be the worst math guy. Everyone thinks, you know, just because Mr. I or David Kang is Asian, he must be good at math. No, no, no. I used to be so bad at math. I used to have to take, you know, hire mentors, you know, tutors and all that, right? And I still sucked. Anyways, just to encourage you guys, for those that suck math, don't worry, okay? It's all step-by-step approach. Are you new to trading, or are you looking to increase your knowledge about trading? Either way, it doesn't matter, okay? After this video series, after all of that, the course content you guys go through, I am very confident that you will succeed in the stock market with us, okay? So let's move on. So what is a stock? A stock, also known as shares or equity, is a type of security that signifies proportionate ownership in the issuing corporation. All right, so this entitles the stockholder to that proportion of a corporation's assets and earnings. Let's go ahead and take a look at the key takeaways. Key takeaway number 1. A stock is a form of security that indicates the holder has proportionate ownership in the issuing corporation. Cool. Key takeaway number 2. Corporations issue stock to raise funds to operate their businesses. Now, there are 2 main types of stocks. What are they? Common and preferred stocks. Okay. Key takeaway number 3. Stocks are bought and sold predominantly on stock exchanges, though there can be private sales as well. Okay, and they are the foundation of nearly every portfolio. Now let's go ahead and take a look at key takeaway number 4. Historically, stocks have outperformed most other investments over the long run. And that is why I love the stock market. I've been in it for 8 years straight, and I would love to keep going, and I will keep going till the day I die. So better than the Forex market or the crypto market that I've been previously before. So stock market all the way, baby. All right, so what are shares? We just really talked about it, but to be more, you know, detailed, a share is the single smallest denomination of a company stock. So if you're divvying up stock and referring to specific characteristics, the proper word to use is share. So you guys all know back in the days, man, oh man, back in the days, everything used to be on paper, right? With use of certificates, and you would have to call a broker and hello, wait in the line, and call up your representative and to execute a trade for you, right? No longer is the case. Thank God, technology is getting better. These days, everything is simply done from the comfort of your home at a computer, or if you're on the go, from a cell phone app. So therefore, investing is more accessible than ever before, and this helps drive more people to be interested in investing, right? So let's talk about more detail on the different types of shares. We just kind of briefly talked about common shares and preferred shares. Here, we're talking about common shares a little bit, all right? So common stock represents shares of ownership in a corporation and the type of stock in which most people invest. When people talk about stocks, they are usually what? they're referring to common stock. Okay, that's what you need to know. In fact, the great majority of stock is issued in this form. Common shares represent a claim on profits or dividends and confer voting rights. Confer voting rights. Keep that in mind. Now, what's the difference between common shares and preferred shares? Here it is. The main difference from common stock is that prefers come with no voting rights. So there it is. So when it comes to time for a company, right, to elect a board of directors or vote on any form of corporate policy, preferred shareholders, they have no voice. Zero, zip in the future of the company. You got no voice, right? So in fact, preferred stock functions similarly to bonds also, since what? With preferred shares, investors are usually guaranteed a fixed dividend in perpetuity. Okay. Now moving on, we got the difference between private and public company. It's very simple. Privately held companies are privately held. No duh. This means that in most cases, the company is owned by its founders, management, or a group of private investors. Okie dokie. And what about public? A public company, on the other hand, is a company that has sold all or a portion of itself to the public via an IPO. What does IPO stand for? It says it right there. Initial public offering, meaning shareholders have a claim to part of the company's assets and profits. Okay, so that is what the difference between public and private company is, right? Now, what is the benefits of a public company? Okay, they get to tap the financial markets by selling stock as an equity or bonds or debt to raise capital, right, cash, for expansion and other projects, as well as offer stocks and stock option programs to companies' employees, as well as leveraging with banks. So those are all of the things, benefits that you need to know about a public company. All right. So now, what is a stock market exchange? Everyone should know this. Okay. It's basically a facility where stockholders, or excuse me, stock brokers and traders can buy and sell securities such as shares of stocks and bonds and other financial instruments. Get it? Got it? Good. So stock exchanges, guys, may also provide facilities for the issue and redemption of such securities and instruments and capital events, including the payment of income and dividends. Okay, did you get that? So now, what are the top two main exchanges in the United States? Here we got NYSE. What does NYSE stand for? New York Stock Exchange. All right, so New York Stock Exchange, we got the NASDAQ. What does NASDAQ stand for? Here we go. Not many people know it, but I think I do. National Association of Securities Dealers Automated Quotation System. I hope that is right. I'm pretty sure I am correct. So let's move on. What is a bull market? A bull market is the condition of a financial market of a group of securities in which prices are rising or are expected to rise. So basically, let's say you and I are bulls. We are bulls in the stock market. What does that mean? It means that you and I, we are predicting or expecting stocks or the stock market to go higher. And when it goes higher, what is how we make money? So the term bull market is most often used to refer to the stock market, but can be applied to anything that is traded, such as bonds, real estate, currencies, and commodities. Bull markets tend to last for several months to several years, right? So that is what a bull market is, or we will call it when we're trading. Oh, it's bullish. You'll probably hear that. We'll go more about it as we get deeper into the trading course. But the opposite of bull market is called what? Bear market. Okay, so a bear market is the condition of a financial market of a group of securities in which prices are retracing or are expected to drop. So let's say you and I are bears in the market. That means what? We are expecting or betting or predicting that the stock or the stock market is going to go lower. Then that is how we make money. Okay, by predicting the stock or the stock market is going to go lower. Okay, so the term bear market is most often used to refer to the stock market, but can be applied to anything that is traded, such as bonds, real estate, currencies, and commodities, just like the bull market, right? But it's just basically the opposite. So bear markets tend to last for a few months to few years, shorter than the bull market, okay, historically, based on the history. So I would probably say bear markets usually last about 2 years on average, okay? So let's move on to the next content here. So we got types of trading. We got scalping, day trading, swing trading, position trading, investing, and shorting. Wow, what are all these types of trading? So basically, the main important key takeaway that I want you guys to get from this is that look at the chart or this picture right here. We got scalping, day trading, swing trading, position trading, investing, and shows all these years, months, weeks, days, and minutes. So basically, they are all types of trading, but you are seeing different time frames. Meaning, let's say if I was scalping, okay, or let's say I'm scalping a stock, it means that I am basically buying the stock and selling the stock within few seconds to few minutes. Basically, I'm seeing stocks that are moving up, a few percentages or a few cents or whatever, and I'm just making money as the stock price goes up. I'm buying on the the dip or the demand, or when it pulls back on the lower price, I buy it again and sell the quick spike. So I'm making smaller profits, but smaller profits add up, right? So that's what scalping is, and that's what I do as well. And then we do day trading, right? Day trading is basically a time frame of anywhere within the day. So you're buying the stock or security and you're selling the stock or security by the end of the day. So the stock market opens at what time, everybody? 9:30 a.m. Eastern time, and closes at what? 4 p.m. Eastern time. So if you buy the stock within that time and sell it within that time, okay, that is considered a day trade. FYI, for your information, there is what's called pre-market. Pre-market opens at what? 4 a.m. Eastern time, and it is done by the market opening at 9:30 a.m. And then we also have what's called after hours. After hours trading is basically when the market closes at 4 p.m. From that time, it goes on for another 4 hours till 8 p.m. Eastern time. So basically, we'll get more into that, but just know that those times exist. And so anytime you trade pre-market or after hours within that same time and that day, that is considered day trading. Okay, and the swing trading is basically you're buying the stock before the day closes. Okay, and so you're holding overnight. You're holding that stock overnight, hoping, or you're predicting to sell at a higher price the next day. So that's the minimum, right? The minimum time you're holding overnight to a few days / few weeks. Position trading, few months. Investing, few months at the least to few to several years, right? And then shorting. What is shorting? Now, shorting is for more professional traders, for more experienced traders. But basically, what shorting is in terms of the time frame, it will fit in right between the day trading and swing trading. So right between there. So day trading is within the day. Swing trading is what? Overnight to few days / few weeks, right? So shorting is basically when basically you and I are bears, right? Where bears do what? Bears want the stock to go down. That's how they make money. They're predicting or betting that the stock's going to go down. So we'll talk more about shorting, but the basic idea you need to know is that shorting, you're basically going opposite of the bears. So you are basically betting the stock's going to go down. So that's going to be within the day trading time frame to swing trading. Okay, but usually is within the day. Okay, all right. Other than that, what does market cap mean? Market capitalization refers to the total dollar market value of a company's outstanding share of stocks or shares of stock. Okay, so it is commonly referred to as market cap. We like to keep it simple, nice and simple. Not, hey, what is a market capitalization? We just say market cap. What's a market cap? Right? It's basically calculated by multiplying the total number of a company's outstanding shares by the current market price of one share. Make sense? Okay, so for example, it says right here, a company, we have a 10 million shares selling for $100 each. Okay, a company with 10 million shares selling for $100 each would have a market cap of what? 1 billion. So the investment community uses this figure to determine a company size as opposed to using sales or total asset figures. Does that make sense, everybody? So obviously you don't need to calculate the market cap. Everything with this technology these days is already calculated for you, so you don't have to actually calculate. So there's really no math involved, okay? Now let's move on. What are authorized shares? Authorized shares refers to the maximum number of shares that our corporation is legally permitted to use, as specified in its articles of incorporation in the U.S. or in the company's charter in other parts of the world. Okay, that's kind of boring, but it is also usually listed in the capital accounts section of the balance sheet. Boring again. Authorized shares should not be confused with outstanding shares, which are a number of shares that the corporation has actually issued that are held by the public. Something you should still know, but you don't really need to know, but still need to know. Makes sense? So basically, when a company is formed, it decides on the maximum number of shares it would like to offer. So these shares are referred to as authorized stock. Authorized stock. So you now know what our authorized shares are, right? So the shares are now issued to the public to trade on the open market, comprise all or a portion of a company's authorized stock. So the number of shares actually available to trade is known as float. That is very important. Float. I want everybody to understand, write it down. What is float? The float is the number of shares that is offered to the public. If you are in my prosperity training team, I will say that every single morning live. Why? Because I love low float stocks. So what is float? In terminology settings, the term float refers to regular shares a company has issued to the public that are available for investors to trade or traders to trade. Okay, this figure is derived by taking a company's outstanding shares and subtracting any restricted stock, which is stock that is under some sort of sales restriction. Let's move on. Restricted stock can include stock held by insiders, but what? Cannot be traded. So, Flo, when you are my trading team and you want to make money with me, you're probably gonna see me trading low float stocks. What are considered low float stocks, ladies and gentlemen? Low float stock is considered anything over 10 million float. Okay, 10 million in float. Most blue chip stocks have high floats of in the in the 500 million at least, I would say. Okay, we'll talk about what blue chip stock is in the next few as we move forward. But basically, I like to trade low flow stocks. Just keep that in mind. Okay. Other than that, how to calculate a company's float? Again, for you geeks, if you want to know how to calculate all this stuff, here it is. For example, let's say a company XYZ, which doesn't exist, has 20 million shares in float. Okay, in total, but 15 million shares are held by insiders who acquire these shares through some sort of type of share distribution plan. You get it? So therefore, what do we do? Now we look at the company's float, which would be 5 million. How did we get that number? 20 million minus 15 million gives you 5 million. Okay. In other words, only 5 million shares are available for trade, meaning that is a low float that meets our requirement under 10 million float. That is what I like. That means the lower the float, the lower the shares that's offered to the public for traders to trade or invest. Meaning, if there's a large guy or a large trader or investor that has a lot of money and bought those shares, there's going to be less limited amount of shares for the other guys to buy, correct? That means what? There's demand. Let's say a company releases a good news, but somebody already bought it. There's only a few shares left. What's going to happen? Somebody buys. There's not enough shares available to the public. The stock is going to spike. There's more volatility. That is how we see stocks running up 100%, 200%, 300%, and even up to rare case 1,000%. We've seen one running up even 2,000% about 2-3 years ago. If you have been in my trading team, so really exciting times right now for you to be in because we are seeing a lot of volatility in the stock market. A lot of new day traders coming in. Right? They see the power, they see the potential, the freedom they can get. There's so much I can list about day trading. I mean, we'll go more into it later, but for now, let's go ahead and get the basic terminologies and all that. What is an IPO? We said it's initial public offering, but for more details, initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance, right? So public shares issuance allows a company to raise capital from public investors. They take capital from public investors. Get it? So the transition from a private to a public company can be an important time for private investors to fully realize gains from their investment. As why? Because it typically includes share premiums for current private investors. Okay, we talk about private versus public, right? So here we are. Meanwhile, it also allows public investors to participate in the offering. That's what you need to know basically right now. Here we are, blue chips. I mentioned blue chips. So you've heard of blue chips. What is exactly blue chip stock? So here we go. A blue chip stock is a huge company with an excellent reputation. Can you think of any huge company with an excellent reputation? I can already think of one. Amazon, right? Not a lot of you. I mean, a lot of you use Amazon, right? Amazon shipping or the Amazon.com, right? You buy stuff online. One of the largest companies in the world, right? So these are typically large, well-established, and financially sound companies that have operated for many years that have dependable earnings, often paying dividends to investors. Okay, dividends. You know what they are? We're about to explain that in a little bit. But a blue chip stock typically has a market cap in the billions. Did you hear that? In the billions. This ain't no penny stock. Okay, penny stocks have low market cap. Okay, here we are, penny stocks. What's penny stocks? A penny stock refers to a small company stock that typically trades for less than $5 per share. Now, usually, I still consider penny stocks anywhere from $1 to $10 range. Even under $1 is considered penny stock. Sometimes we do see stocks over 10, but again, there's no guarantees. There's no exact science in the stock market, right? It's all an art. So I like to make sure everybody understands anything under $5 or just $1 to $10 range and has a low float and low market cap, right? That is considered a penny stock, basically. You can see here the definition, but that is how I would describe a penny stock. And I love penny stocks. Why? Because I've been trading for 8 years, and that's where most of my income or money that I made in the stock market has come from. So it's a game that you need to properly learn that I'm going to teach you guys. It's basically rinse and repeat after that. Rinse and repeat. The stock market is nothing but knowing the game, okay? Knowing the game and just having the discipline and staying away from fear and greed, being a good emotional manager and good risk manager. And I can't wait for you guys to tune in for that more as we go forward, okay? So here we go again, another boring topic, but hedge fund versus mutual funds. You need to know these guys, okay? When you guys get to some sort of dinner, okay, with high net worth folks, this is how I network, okay? Because I know much about the stock market, right? I'm able to sit down, I'm able to talk numbers, I'm able to talk about stocks and investments. That's the big boys world, all right? When you go to dinner, we're not talking about some girls who you hanged out with. You know, we're not talking about drama or gossip. And we're talking about stocks or any kind of investments or all that good stuff, right? So hedge funds and mutual funds. Both mutual funds and hedge funds are managed portfolios built from pool funds with the goal of achieving returns through diversification, okay? So now this pooling of funds means that a manager or group of managers uses investment capital from who? Multiple investors to invest in securities that fit a specific strategy, okay? So now let's talk about mutual funds. Mutual funds are offered by institutional fund managers with a variety of options for retail and institutional investors, and hedge funds target high net worth investors. High net worth investors, okay? So these funds require that investors meet specified accredited characteristics. Does this all make sense? A lot of you guys, a lot of people kind of message me, random people all over the, different social media, and they're like, hey man, do you trade or invest? I'm like, no, dog, look at my profile. My bio says I'm a trader or investor, right? And then they're like, okay, so I trade and invest in the stock market too. I'm like, cool. So what's your question? He's like, well, I use this app called Acorns. I'm sure a lot of you guys saw ads and probably downloaded Acorns because why? Why is it so attractive? You don't have to do anything, right? All you do is just put your money in, by some random dudes, and that's what really mutual funds is, right? You're basically, this app is taking all this money from other people, and they're just kind of basically based on their like algorithms or calculations, they're kind of giving you guys within 40 years, by your 40 years old or whatever age that you calculate how many more years you got from your personal investment since then is how much you're gonna make. And guess what? That is not a lot of money. Okay, not a lot of money for how long you have to wait. So why is learning how to trade so important? Because manual trading is the best way for you to increase your chances and your profits. Okay, your profits, say you can make 100% in a day versus somebody making 20% in a year. Okay, so instead of giving money to somebody else and not knowing what's going on and just taking care of them and then taking their fees after you getting some profit because of their work, it's so much better if you just learn the game. And there's so much more other benefits than just the money. Now, what is an ETF and SPY? Okay, you've probably heard of this. ETF stands for Exchange Traded Fund, and that's a type of security that involves a collection of securities such as stocks, okay, but also often tracks an underlying index, although they can invest in any number of industry sectors or use various strategies. Okie dokie. So ETFs are in many ways similar to mutual funds. However, they are listed on the exchange, and ETF shares trade through the day, out the day, just like ordinary stock. Okay. Now, what is the SPY? Okay, both of these are very important for you guys to understand. Okay, the SPY, we traders and investors both use this to track the Standard & Poor's 500 index. The Standard & Poor's, that is the full version of the S&P. So the Standard & Poor's 500 is the S&P 500 index, which comprises 500 large and mid-cap U.S. stocks. So these stocks are selected by a committee based on the market size, liquidity, and industry. That is how they calculate whether or not they should be in the S&P 500 or not. Okay, so the S&P 500 serves as one of the main benchmarks of the U.S. equity market and indicates the financial health and stability of the economy. Make sense? Pretty simple if you actually are focusing. Now, major indices to know. Indices, not indices. For a lot of you guys that are pronouncing it wrong, it's indices. Major indices to know. DJIA, S&P 500, the Nasdaq Composite. Let's start with DJIA. It stands for the Dow Jones Industrial Average, which is a what? Index that tracks 30 large publicly owned companies trading in the New York Stock Exchange, NYSE, we talked about it, and the NASDAQ. So the Dow Jones is named after Charles Dow, who created back in 1896. Wow. and his business partner named Edward Jones, which you probably heard of with guys that are selling. I think not. They don't just sell insurance, but it's a financial group, Edward Jones, right? I was part of that group when I was in early college years, right? Trying to make some money, but didn't work out for me. Anyways, the S&P 500 Standard & Poor's 500 Index is a market capitalization weighted index of the 500 largest U.S. public traded companies. We talked about that, right, on our earlier slide. So the index is widely regarded as the best gauge of large cap U.S. equities. That's something you need to keep in mind. Okay, you have to look at the S&P 500 so that you can get the best gauge of large cap U.S. equities in case you really just want to focus on blue chip stocks. So other common U.S. stock market benchmarks include the Dow Jones Industrial Average, or what, the Dow 30, and the Russell 2000 Index, which represents the small cap index. All right, there you go, small cap index for you penny stock lovers like me. Small cap index, Russell 2000 index. All right. So the Nasdaq Composite, on the other hand, is the index is a market capitalization weighted index of over 3,300 common equities. 3,300 over. Okay, listed on the Nasdaq Stock Exchange. All right. So let's see here. See here we got two pictures of stock market sectors, and on the right we got market sectors, right? So what's important is the left side, the stock market sectors. Now the market sectors is a kind of like a general view of the sector in the market, right? We got the basic materials. Under basic material, we got services. We got the non-cyclical goods. Under that, we got technology. We got the cyclical goods. We got the conglomerates. Underneath that, we got financial, right? But in order to really break it down, because listen, in the stock market, it's all about what? Narrowing down your options. So let's say, look at the left side. We got energy, materials, industrials. We got even financials, utilities, and information technology, and yada, yada, yada. All right? So let's say you hear from the news or from your grandma, say, hey, I heard that the energy sector is up, or you hear the news that the energy sector is up. What stocks are you going to be focusing on? For example, energy stocks. Can you think of any energy companies under energy sector? 3, 2, 1. One thing that comes to mind is ExxonMobil. You've heard of it. What else? Royal Dutch Shell, right? Shell. We also got Chevron. We also got what? BP. All right. So to name a few, those are energy companies. So anytime you hear energy sector being up, you can bet that the volume is going to be coming, meaning buyers are coming in towards those companies, and you can see those companies going up, right? What about financials? Any companies that you guys can think of? Bank of America, we got JP Morgan, we got American Express, Goldman Sachs. You've probably heard of all those, right? For those that use credit cards and all the banking financials, right? So we can look forward to those stocks. Or if you run into any stock and you look at, hey, what sector is this stock in? And you know, oh, wow, this is in the financial. No wonder the stock is up. So there may be other companies, like even the smaller cap stocks, right? Like the penny stocks that may be moving up because other people saw and heard that the financial sector is up. They're going to be looking for those. They're going to be buying into those. And when other buyers come into those stocks, other people see that the buying volume is increasing. Therefore, the stock price is going higher and higher. And then what else? What creates that when there's a lot of buying? FOMO, fear of missing out. People buy based on, oh my God, I got to get in right now. This is the hype. Everyone's buying. The stock's going to go up. Some people start rumors. That is how things go. That's how, like, what? The Bitcoin started, right? Everybody started getting hyped up, and the stock, or not the stock, the crypto, Bitcoin, right, just blew up. And then after that, it was just hype, and it just comes all the way crashing down. Anyways, that's another time to talk about. But next slide here, we're almost done. What does a yield mean? Yield refers to the earnings generated and realized on an investment over a particular period of time, and is expressed in terms of percentage based on the investment amount, okay, invested amount, or on the current market value, or on the face value of the security. Makes sense? So this is going to include the interest earned or dividends received from holding a particular security. And depending on the nature and diversification, or excuse me, nature and valuation, which is the fixed and fluctuating of the security, right? Yields may be classified as known or anticipated. That's just basically what you need to know about yield, okay? Now, what is a stock dividend? You probably heard of it a lot. Oh yeah, man, I'm getting, dividend off of this company. A dividend is basically the distribution of reward from a portion of the company's earnings, and it's paid to a class of the shareholders. What are shareholders? Shareholders are people that invested their money in exchange for shares into that company, right? So dividends are decided and managed by the company's board of directors, though they must be first what? Approved by these shareholders through their voting rights. So shareholders have what? Voting rights in a stock dividend. So dividends can be issued as cash payments, as shares of stock, or other property, though cash dividends are the most common. Okie dokie. So along with companies, various mutual funds and exchange traded funds also pay dividends. And you guys got that cute picture right there. We got profits with 5 green highlighted circles. Moving toward that, on the right, portion of profits distributed as dividends. What is a broker? Everybody asks me, hey man, what broker should I apply for? Broker is basically what? Is where you fund your money to a broker or institution that manages to trade, right? And that is where you can trade your money to exchange for the shares of the company that you want to invest in, right? So a broker is an individual or firm that charges a fee or commission for executing buy and sell orders submitted by an investor. Now, these days, you guys are lucky. We're not seeing a lot of brokers, charging a commission. Why? Because there's so much competition going on right now, right? Just recently, actually. Recently, we are seeing a lot of U.S. brokers that are facing a lot of competition. Therefore, they are either they're pretty much getting rid of commission. So that way we can attract more traders and investors or people to trade and invest in the stock market, right? So a broker also refers to the role of a firm when it acts as an agent for a customer and charges the customer a commission for services. But nowadays, like I said, you're not going to really see a lot of brokers that charges you a fee unless you are looking to trade offshore. Okay, so that's another story we can talk about. But basically, what you need to know is that for a broker, and that's pretty much it, ladies and gentlemen. So that covers our chapter 1 intro into the stock market. I hope you guys enjoyed. Thanks so much for tuning and staying laser focused. I just want to make sure you guys are enjoying this content and really putting that into your head. So that way you can apply it to your trading, and through your trading, all right, you're going to have success with us. All right. I'll see you guys in our next